Some people treat indicators like vacation days. Grab as many as you can and you'll have a great time. Where in reality, keeping your scope focused when choosing indicators can help keep your trading clean. Hey, this is Joey with NinjaTrader. Today we're covering 5 technical indicators every futures trader should know, so you have a structured framework for reading the market. Before we get into the indicators themselves, it's worth understanding what they actually are. Technical indicators are mathematical calculations applied to price, volume, or time, and they help identify patterns, trends, and potential turning points. They don't predict the future, but they give you a repeatable framework for reading the market instead of just reacting to it. One distinction worth knowing up front: some indicators are leading and some are lagging. Leading indicators try to signal what price might do next. Lagging indicators confirm what price is already doing. Most of what we're covering today falls into the lagging category, which makes them better for staying aligned with a trend than for calling a reversal from scratch. Let's start with moving averages, typically the first indicators traders learn, and one they rarely stop using. A moving average smooths price data over a set number of periods, making it easier to see the direction of a trend without getting distracted by short-term noise. There are 2 main types: the simple moving average, or SMA, which gives equal weight to every price point in its look-back window, and the exponential moving average, or EMA, which gives more weight to recent prices so it reacts faster to new information. In the fast-moving environment of futures markets, many traders may prefer the EMA for that responsiveness. When price consistently trades above a moving average, the market is in an uptrend. When it consistently trades below, it signals a downtrend. A popular approach is watching for crossovers between a shorter-term and a longer-term moving average. When the faster one crosses above the slower one, it can signal the early stages of an uptrend. A moving average shows you which way the trend is leaning, up or down. However, it won't tell you how strong that move actually is, so pairing it with a momentum tool like RSI gives you the fuller picture, direction plus strength, so you can tell if that trend's actually got legs. Which brings us to RSI, the Relative Strength Index. RSI measures momentum on a scale of 0 to 100. Readings above 70 are typically considered overbought, and readings below 30 are considered oversold, helping traders identify potential reversals. It uses a 14-period look-back by default and is one of the most widely cited tools in technical analysis. Now, overbought doesn't mean price will reverse immediately. It just means buying pressure has been intense and a pullback is more likely. In strong trending markets, RSI can stay above 70 for extended stretches, so it's most useful as context, not as a standalone trigger. RSI becomes especially powerful when it diverges from price. If price makes a new high, but RSI makes a lower high, that's a classic warning sign that the move may be running out of steam. Another useful indicator is whether you've hit like and subscribe. 5 indicators can be a lot to learn at once, so you may want to bookmark this video and reference it later. Anyway, MACD, which stands for Moving Average Convergence / Divergence, tracks the relationship between 2 exponential moving averages, typically a 12-period and a 26-period, and plots the difference as a line alongside a 9-period signal line. When the 2 lines cross, it can signal a shift in trend direction. A bullish crossover happens when the MACD line crosses above the signal line. Many traders use this as a potential entry cue in a confirmed uptrend. A bearish crossover signals the opposite and can indicate a time to exit or consider a short position. The histogram bars between the lines show the distance between them, giving you a live read on how strong or weakening that momentum is. MACD and RSI complement each other naturally as a pair. Use MACD for spotting trend shifts and RSI to confirm whether momentum is actually behind them. VWAP, the volume-weighted average price, is one of the most widely used futures trading indicators because it shows the average price at which a contract has traded throughout the day, weighted by volume. That gives traders a benchmark to gauge whether price is trading at a fair level. When price trades above VWAP, the session has a bullish bias and buyers are paying above the day's average. Below VWAP, the bias is bearish. Many professional traders use it as a decision line, looking for long setups above it and short setups below it. That makes VWAP one of the more intuitive indicators to start with, especially when trading contracts with lower intraday margins like micro E-mini futures. Because VWAP resets at the start of each trading session, it's most relevant for intraday traders. Pair it with the moving average for a clearer read on how price fits into the broader trend. And then there are Bollinger Bands. They consist of 3 lines, a simple moving average in the middle, flanked by 2 bands set at standard deviations above and below it. When volatility expands, the bands widen. When it contracts, they tighten. One of the most actionable setups Bollinger Bands can produce is called a squeeze, when the bands narrow significantly around price. A squeeze can often precede a sharp directional move. It doesn't tell you which way price will break, but it signals that a breakout may be building. Most traders wait for a confirmed break before entering, and you can add MACD or volume context to gauge whether the breakout has real conviction or is likely to fade. So, how do you put all 5 together without overcomplicating your charts? The goal is to use tools that measure different things: trend, momentum, volume, and volatility, so they confirm each other rather than echo the same signal. For a practical starting combination, use a moving average to define the trend and RSI to gauge momentum, with VWAP to help identify potential entry areas. MACD can add confirmation on trend shifts, and Bollinger Bands become particularly useful when you're watching for a breakout setup. All that said, if you're just getting started, begin with one indicator at a time. Learn what it's telling you before layering in a second. NinjaTrader's platform includes over 100 built-in technical indicators, including all 5 of these, and you can apply and customize them directly on your charts. You can also practice using them risk-free in the NinjaTrader trading simulator before ever placing a live trade. The real learning happens when you apply these tools to live charts, watch how they behave across different conditions, and develop a feel for when they're giving you signal versus noise. If you want to build on this foundation, check out our video breaking down volume profile trading strategies.